Hello, good afternoon, everyone. We are very happy to see you and have you with us today. I'm Alice Nelsner, and I'm the CEO at San Bernardino County Medical Society. And we are so incredibly excited to be partnering with UnisLink. They are our newest preferred business partner with the Medical Society, and they have many solutions they can offer our partner practices, members and non-members, to grow your practice's financial health and offer a lot of creative solutions that you might not have thought of. So if you would be so kind as to keep yourself on mute, that would be wonderful. Feel free to enter any questions into the chat as we go along. And what we'll probably do is wait until the end of the presentation to get to most of those. But if our presenter, Mr. Muir, sees something that strikes his fancy, he may just go ahead and jump on into that response. But we'll play that by ear, and we encourage you to ask questions today. So let me introduce our wonderful presenter. James Muir, Vice President of Sales for UnisLink, is a 30-year revenue cycle expert, having led revenue cycle team for Conifer, NextGen Healthcare, AVAAP, and many others. Mr. Muir is a highly respected growth leader, best-selling author, speaker, and seasoned revenue cycle expert, specializing in leveraging process and technology to improve financial performance for clients and personal value for their stakeholders. Mr. Muir has done extensive work for some of the largest names in technology and healthcare, including HCA, Tenet, Catholic Healthcare, Banner, Dell, IBM, and others. Throughout his career, Mr. Muir has focused on helping leaders in healthcare think through and overcome their biggest business challenges and to reach their potential goals. And he is going to help us do that today and help all of you achieve that. So, James, we welcome you.
Yeah, thanks so much for the introduction, Allison. It's great to be with you and some of your members. I really enjoy these opportunities to share what I find exciting about KPIs, even though some people think it's about as interesting as taxes or maybe root canal. I don't know. But here's what I promise. I promise if you'll hang with me by the end, you'll be excited by KPIs too before we're done. So let's just get rolling and right into it. Now, I often do this session with my close friend and longtime work companion, Patty Peets. But ironically, she is at a client site in California today. So you are left with the guy who's got a face for radio, unfortunately. So, and like Allison mentioned, I've been doing this for over 30 years. I've seen almost everything you can see when it comes to rev cycle. So I'm hoping to share some of that with you today. And here's what we're going to cover. We'll spend a minute on industry challenges, and then we'll talk about what we're going to accomplish during our session together. You're going to come out with some skills, not just some knowledge, but some skills by the time we're finished. And we'll spend a minute on why you should be measuring KPIs, how often we should be doing that, which KPIs we should be looking at. We're going to spend the majority of our time, though, talking about how to calculate them and the different ways you can use them. And then I'm going to teach you a very cool way to calculate how much additional revenue your practice can generate if you do improve your KPIs. And it'll be something you can do literally as soon as the session is over. You can go get a piece of paper out. You'll have to run a couple of reports, and boom, you'll be able to calculate that. So that's the best part. So hang with me to the end, because I promise it'll be worth the effort. Because that's great, really, information to share with your docs to help you get the resources that you need so you can do good work. All right, so I have been an MGMA member for many, many years, and MGMA provides many different services. But one of the things that they do that I appreciate the most is that they keep track of the challenges that medical practices are facing kind of across the country. And right now, they're reporting that the biggest challenge the medical groups are facing is staffing challenges. Finding staff, rising staffing costs, turnover, stuff like that. And then they report that revenue challenges are the second biggest. And currently 90% of all practices are reporting that their costs are rising faster than revenue is. The third on the list is expense challenges, and that's really just the flip side of revenue challenge. And then finally, they list technology challenges as the fourth biggest one. And I just noticed that I got a survey from them the other day. And so I would expect a whole new version of this to come out in the next month or so because of that survey. So with that in mind, I would say that all of those challenges are things that can affect the financial performance of the group. So the goal of this session is to discover how to measure key performance indicators and how to use them to actually improve your financial performance. So it's a very practical goal here. And there's a common phrase that we say around here at least 2 or 3 times a day each, and it comes from Peter Drucker, and it basically goes like this: if you can't measure it, you can't improve it. And just due to the nature of what I do, I talk to practices several times each week that are struggling to identify why their performance is down and they're looking for some kind of help. And what I would say is that the best place to start is with your key performance indicators. Your KPIs will point to the areas that you need to dive into and look at more deeply. And by analyzing your KPIs, not only can you relatively quickly identify where you need to focus, but you can also determine just how much money you could be leaving on the table. And that's going to help you prioritize your improvement efforts. And in that little simple statement, if you can't measure it, you can't improve it. That's really the seed of why we would even want to look at our KPIs in the first place, right? We want improvement. And what that data is going to do for us, it'll help us identify where we're underperforming, maybe losing money. It'll help us where we're doing well and we're really profitable. It'll help us identify problems and risk areas. We can use that data to calculate the financial upside of fixing a problem. It'll tell us why it's a problem, how we can fix the problem, and it can help identify what our full potential is. And so that's a pretty good return for looking at some data. And so I'm going to give you a number of key points throughout this session together today. And this is the first one, and that is this: key performance indicators, right, good or bad, can always be traced back to operational issues, okay? Meaning that KPIs are really simply indicators of our operational performance. And the second key point that I'm going to give you today is this: without constant monitoring, it is hard to know where you should be looking for the root cause of financial issues. It's not enough to look at your KPIs just once a year. But let me ask you this: when do we usually start looking at our data, right? Like when do you start looking at your key performance indicators? Usually it's when we have some kind of a problem, right? Like suddenly the house is on fire or something is down. Usually it's provider compensation. And we think, man, I got to figure out what's causing this. Why is this happening, right? And what you see here on this list is a list of the most common trigger events that cause practices to start taking a closer look at their data. And it's broken down into 3 different areas: financial triggers, administrative triggers, and everything else. But it's usually when we experience one or more of these trigger events that we start really looking into the data to figure out what's happening. Now, here's what MGMA says, how frequently practices look at their data. 41% of them are looking at their data annually. 24% of them are looking at it quarterly. 15% of them are looking at it monthly. And shockingly, 15% of them never look at it. Okay. Now, in all fairness, I think MGMA is talking about benchmarking here, which is technically a little higher standard than just looking at your KPIs here. But let me just take this exact same data and frame it for you in a slightly different way, because when you look at it this way, it's kind of shocking. What it means is that 80% of groups are looking at their KPIs less than once a quarter. Okay, so again, same data: 41% are doing it only once a year, 24% are doing it quarterly, 15% never do it, and those 3 added together equal 80%. Yikes, yikes. So here is your third key point of the day: key performance indicators should be looked at monthly. Monthly, that's the magic answer. And that sort of begs the question: okay, James, I get it. I should be measuring them monthly, but what should I be measuring? And I'm sure you know all of these, and there are many more than are listed here, but here's the ones that are the top ones to be looking at. We want to look at our AR over 120. We want to look at our days in AR. We also want to break that apart by insurance and by patient. We want to look at our gross collection rate, or our GCR. We want to look at our revenue realization rate, which might be a new KPI for some of you. We want to look at our net collection rate, or our NCR, which is probably the most important metric. We want to look at ARE, our average reimbursement per encounter, and our denial rate. These are the most important ones, okay? And what we're going to do now is we're going to go through each one of these and talk about how to calculate them and what the root cause typically is when they're outside the normal range, and then how you can use those to improve your financial performance. So here we go. Okay, we're going to start off with AR over 120. And this is the total amount of your accounts receivable that's over 120 days old. And this benchmark does vary a little bit by specialty, but the benchmark is that less than 25% of your total AR should be over 120 days old. In fact, preferred would be more like 9 to 15%. Okay, and that's a completely achievable number. But the implications of having an unhealthy AR over 120 are delayed cash flow, higher risk of non-payment. In fact, only about 20% of AR over 120 is ever collected. Very sad. Increased admin costs. And usually you see that in the form of either additional follow-up effort, overtime. Sometimes it means hiring additional staff. Decreased patient satisfaction. And I just saw this report from McKinsey like 2 weeks ago. What the data shows is that how you handle your accounts receivable process with patients has almost as much impact as their interaction with the physician does, which is mind-blowing, right? Compliance issues, depending on your contracts with payers, you can bump into compliance issues. In the worst case, it will increase your financing costs. Like if you get into a situation where it's so bad that you have to take out a line of credit to make payroll, then now you're paying interest on all that. If you are considering selling your practice or you're trying to get a loan and you're evaluating the practice, how much of your AR is over 120 also affects the valuation of your practice. So this is all stuff that we want to avoid. So how do you calculate this number? Well, the formula is really simple. We're going to take the total dollar value of our accounts receivable over 120 days, and then we're just going to divide it by our total accounts receivable. That's going to give us a percentage that is less than 1, and what we're looking for is something in the 9 to 15% range. Okay, but with AR over 120, there is a special nuance. We need to break it down into patient AR that's over 120, so the patient side, and then the insurance AR over 120. And that's because that little difference helps us more accurately identify what the root cause of our challenge is going to be, right? And what you're looking at here is real data from an assessment I did about a month ago. And what you can see is that an incredible 93% of total AR, this is on the left-hand side, is still out to payers, okay? And even when we go all the way past 120 days, which is plenty of time for the payers to have paid, we still see an incredible 85% of the total AR is still out to payers, okay? And we're going to go more in more detail on the root cause of all this in a second, but you know, what could be happening here when we see something like this? The truth is there's a few things that could be happening. I mean, it is possible that it's the payer's fault, right? All of the payers, right? But from here, what it looks like is that it's the problem with all payers and not just the problem with 1 or 2 payers. And by the way, while I think that all payers are inherently evil, it is pretty unlikely that all of the payers are universally going to exhibit the exact same problem. And so, and by the way, a insurance aging report, right, would tell you that. It would tell you which ones are old and which ones are not, which ones are performing better from an aging perspective. What's more likely to be the issue here is that our own team that follows up on the insurance is unable to keep up with all of the denials and the requests for information that's coming back from the payers. And there's some other indicators we can use to confirm this. But here's the funny thing, or it's not funny at all, it's what's terrible about this, is for most practices, the majority of the patient money is actually collected after the insurance has processed. And so what that means is our inability to stay caught up on the insurance issues is also affecting our ability to collect the patient balances, okay? So more on that in here in just a second, but it's kind of a double whammy. All right, so what causes AR over 120 to be high? Well, the truth is there's quite a lot of things that can contribute to a high AR over 120. And what you see is the most common places to look, and I would kind of look in this order too. But first, 100% of your claims should be passing the clearinghouse, right? So if you're getting any rejections at all, you should start there and keep iterating improvements until you're at 99% or better, okay? Denials are probably the biggest contributor to AR over 120. And the key here is to look at the types of denials that you're getting and then work backwards from there. For example, it's really not uncommon at all for 30 to 50% of a practice's denials to all be related to insurance coverage issues, okay? I know that because we run assessments every week, and I usually see that. And when I say insurance coverage issues, I mean, is the patient's insurance active? And is the service that you're about to perform, is that a covered benefit for them? Okay, and if we see a lot of coverage type denials, then it's time for us to review our intake process. Okay, remember, all KPIs can be traced back to operational issues. But it's not uncommon, for example, for practices to check for active coverage, but not check to see whether a given service is a covered benefit. So if we see that a benefit check is going to help address our denial challenge, then we need to consider adding that step to our eligibility checking process. Okay. All right. Inadequate follow-up and denial management is basically the example we just covered in the previous slide, right? So, and this might be worth writing down. Denials can be worked at about 6 to 8 per hour. That's how many a human being can do in about an hour. Okay. It depends a little bit on the denial, but using that rubric, you can easily calculate if your denial volume is more than your current team can keep up with, right? An inadequate patient collection process will also absolutely affect your AR over 120, as well as lower your net collection rate. In general, the best time to collect patient balances is before rendering service. Okay, more on that in a minute. If your doctors are not completing their notes in a timely fashion, then there's another metric that we're not going to cover today, but it's called charge lag, and that number is going to be high. So, I mean, if it's taking them 7 days to complete a note, then we are unnecessarily adding 7 days to our AR days, which contributes to the AR of 120 being higher. If you never write anything off, okay, then your AR over 120 is just going to spiral out of control. And you will be missing out on some important tax deductions if you're using the accrual counting method. So for some reason, some doctors never write anything off, right? Hoping beyond hope that it's going to come in someday, and my attitude and suggestion is if it's worthless, you should write it off and get it off of your books because it's actually consuming time. So lastly, I would say that anytime we have a KPI that is outside of your expected range, it kind of pays for you to examine your standard operating procedures to see if we've given sufficient guidance for our own team so that they can do good work. All right, plenty there. Let's keep moving here. Our next KPI is days in AR. And days in AR is the average number of days it takes for your practice to get paid. It's a metric of cash flow. And a lot of emphasis is placed on this metric. In fact, a lot of people actually think it's the most important metric. And that's because when everything else is done properly, it really is a very good indicator of the overall efficiency of the practice. The lower the number, the faster the practice is getting payment on average. And the benchmark that we're looking for here is 30 days. Now, for some specialties, like hospitalists and ER docs, hospital-based specialties, 40 days in AR is acceptable, but not great. Okay. And the best practice is to have your AR days less than 30. So the implications of not, having an unhealthy days in AR is really very similar to what we saw in the AR over 120. And that includes delayed cash flow, higher risk of non-payment, increased admin costs, and the rest that we saw, right? All that stuff we want to avoid. All right. So here's a little warning for you. Low AR days does not necessarily mean that you are collecting all the money you could be collecting. Maybe your days in AR are low because you're writing off a ton of money to bad debt. That would be bad, right? So this metric by itself does not tell the whole story. That means that in order to get a clearer picture, we also need to combine this metric with our net collection rate, which is a measure of how much money we could be collecting that we actually are collecting, okay? And so more on net collections here in just a second. All right, so how do you calculate days in AR? And I'm sure many of you know this already, but the formula for calculating days in AR is total accounts receivable divided by your average daily charge amount. Okay, and I've broken it down into 3 steps for you here. First, you need to determine your total accounts receivable. That's easy, you just run a report. But then we need to subtract any credits. Okay, and credit balances are balances owed to others, either patients or insurances, that offset receivables. So you got to subtract them out. And when I say that, I mean, when you subtract out credit balances, that means your AR is going to go up, okay? And a quick sidebar about that, this is one of a couple of areas in your KPIs where you really have to know how to handle credit balances, because I've seen many groups with massive credit balance issues. And in general, large amounts of credit balances will fool you into thinking that your performance is really better than it really is, okay? All right, our second step is just to calculate the average daily charge. That's easy. We just do that by dividing total gross charges by the past 12 months. So we just use 365 days. And then finally, we're just going to divide the total accounts receivable by our daily charge. And boom, it's going to give you a number. And hopefully that number is somewhere near 30 days. Okay. All right. So what if it's not? What are likely the issues? Well, the good news is this is the same list that we saw for the AR over 120. So to improve your AR days, you're going to start with the same list that we did when we're looking at our AR over 120. Little shortcut. Okay, our next KPI is ARE, or average revenue per encounter. And like it sounds, the average, this is basically the average amount that your practice collects per encounter. And the benchmark for this KPI, it changes per specialty. So it's not the same, right? It's going to be different for a cardiology group than it is for a pediatric group. So what you're going to want to do is look that up for your practice. A good source of that information is MGMA, but honestly, if you use, pick your favorite artificial intelligence tool right now and ask it, hey, what is the average reimbursement for a rheumatologist, per encounter? And you'll get a pretty good number, okay? And now you've got a benchmark that you can see, am I above that, am I below that? And while this metric is really valuable all by itself, it becomes even more valuable when you start to trend it month over month, like you see here. Again, this thing on the right here is a real chart from a real assessment that we did. Okay, and that's because it's going to alert you to subtle changes in your performance over time that you might otherwise you might not notice it. Okay, so again, that's real data on the right hand side from a recent assessment I did for a group in California, and this is a primary care. Okay. You can see that their best ARE was in the month of January at about $71, which is already dreadfully low. Okay, primary care should always be north of $100. But even more concerning is the fact that their ARE is slowly but steadily getting worse and worse over time, which is a very disturbing trend and an indicator that there's something wrong systemically. Okay, and the implications of a low or a declining ARE is, first of all, low margins. You're not making as much cash as you should be on each one, right? And that ends up leading to decreased cash flow. And that means that the practice usually ends up developing an unhealthy reliance on volume to try to increase practice revenue, okay? And that ends up creating this kind of crazy staffing catch-22 where the practice needs additional staff to handle all that additional volume that they're trying to do. But they can't hire them because the practice isn't generating enough revenue to cover the cost of the additional staff. So they're stuck. And sometimes we see the same thing with technology, right? They know and they need an upgrade, but it's not possible to upgrade because the revenues are lower. And of course, a lower ARE will affect your practice valuation. And it's really a very bad indicator of long-term sustainability of the practice. So it's something that we want to keep an eye on monthly, and we want to address it the second that we see that something is wrong, okay? All right. So as you imagine, calculating the average revenue per encounter is easy. It's the easiest of all the KPIs. You're just going to take total revenue and divide it by the total number of encounters. Okay, that's it. And since you're doing this monthly, you would do that every month, and that you get you get it every month. But it really couldn't be simpler. So I've given you a couple of tips to help you in there. You can look at those later. But I would just say that it's important to break these down month by month, like you see in this little diagram here, so that you can see the trend, right? Is it going up or is it going down? All right, moving ahead. What are the common root causes of a low or a declining ARE? Well, if we're getting a large number of rejections and denied claims, then typically a larger number of those are not going to get paid, which again lowers your ARE. An inefficient or inadequate billing process will cause your denial and insurance to work to pile up, right? And that's going to cause a loss of revenue. A big one, especially in some California markets, is poor payer mix is a major cause of low ARE. Like if most of your payer mix is Medicaid, I should say Medi-Cal, or Medicare, right, or managed care plans, your ARE is going to be lower because those payers pay less. Okay, so you might be lower than the benchmark that you're seeing elsewhere in the country. Poor coding practices can lead to undercoding, and that lowers ARE. And then this will be like tough medicine for some folks, but things like telemedicine, preventive counseling, behavioral health integration, all those things, right? They're all very good adjuncts to regular office visits and procedures, but it's important to remember that they all pay less than routine office visits. So if you're over relying on those services, it is absolutely going to lower your ARE. Okay. An outdated fee schedule might be causing you to charge less than your allowed amount, okay, which would be bad. That would be leaving money on the table. And of course, that's going to lower your ARE. And then it's important to remember that a greater percentage of the practice's overall revenue now is coming from patients because of high deductible plans. And for some practices, it's over 30%. And what that means is we have to get good at collecting patient balances. Okay, not having that will actually reduce your ARE. So these are the places to start if you see a low or declining ARE. Okay, all right, just checking the chat here to see if we've got any questions. All right, so our next KPI is everybody's favorite one. It's denial rate, right? Claim denial rate. And your denial rate is the percentage of claims that are denied out of the total claims that you submitted. Okay, but there's a little nuance here. And that is the denial rate is really not a sufficient KPI all by itself because we're going to appeal some of those claims, right? And many of those are going to get paid. So what we need to do is we kind of need to track two versions of this metric. And those are the initial denial rate, which is the percentage of claims that are denied by payers upon first submission, and then final denial rate, which is the percentage of claims that remain denied after all the appeals of, and all of our efforts to get them paid have been exhausted. And so the benchmark for these two numbers are about 6 to 10% for your initial denial rate, although some payers have wildly higher denial rates. Like Molina got caught denying 30% of claims last year and had a class action lawsuit against them. So sometimes it can be dramatically higher. But the industry benchmark for final denial rate is going to be between 2 and 5%, but it's absolutely possible to get that down to 1 to 2% when you're performing well. I would say virtually every KPI is affected by high denial rates, right? So the implications should look really familiar here, right? Delayed cash flow, higher risk of non-payment, increased administrative costs, and so on, right? All this stuff that we saw before that we want to avoid. Okay, so how do you calculate these? Well, there's two formulas, okay, and you can see them both here at the top. The initial denial rate is simply the total number of denied claims divided by the total number of claims you submitted. Okay, it's that easy. That's going to give you a percentage. Now, the final denial rate formula is very similar. The only difference is that we're going to start with the total number of denied claims that are left over after you've exhausted all of your follow-up and appeal efforts, okay, rather than total denied claims. Now, here is the unfortunate truth. Many practice management systems are not very good at reporting denials. Okay, and you can sometimes work around that by dumping them out into Excel and running pivot tables. But if it's necessary, if like your system's not really doing a great job of reporting denials, then you might want to consider getting that denial data that might be available from your clearinghouse, because most of the clearinghouses will now offer some insights for you at that level. But to keep things simple at first, what I'd recommend is that you want to focus on initial denials from primary payers. Okay, and that's to avoid overstating your denial rate. If you don't do that, then sometimes your system will double count the claim when it's looking at secondaries. So that'll inflate your denial rate unnecessarily. And because of the way many systems report denials, you have to keep an eye out for accidentally counting duplicate claims. And that's just because a new claim is created when a new claim is created and submitted every time we do an appeal. So very often it will count it twice. So again, you got to keep an eye on that. But very often the way you have to address that is you dump them into Excel, do a pivot table, and then group them by encounter number or visit number, so you know you're not counting the same claim multiple times. Okay. All right. Initially, you're just going to calculate your denial rate as a percentage, just like you see in the formulas up at the top. And I don't want to complicate things here, but there is kind of an extra credit step that you can take if you want to. You can run what's called a dollar-based denial rate, which is calculated based on the value of the denied claim rather than the count. And the percentage is better for benchmarking, but the dollar-based method is really better for showing what the financial impact of the denials is. All right, we got to keep rolling here. We're going to run out of time. Okay, so what's the root cause of an unhealthy denial rate? Well, remember what we learned about, at the beginning? Key performance can always be traced back to operational issues. So of all the indicators that we have, denials are the best and the most specific feedback we have on operational issues that are causing financial performance challenges, right? So this is really, really valuable improvement data. And we could easily spend an hour on just denials alone. So let me just make a couple of general observations, and then I'm going to give you a permanent solution that I think you'll find valuable here on the next slide. Okay, now we do hundreds of revenue cycle assessments every single year. And so I have a very good understanding of where the most common denials issues are for most practices. And first and foremost, there's patient coverage issues. Patient eligibility and benefits coverage are easily the most common reason for denials. So that's important feedback, right? When we get a lot of those kinds of denials, it's just telling us that our front end process needs to be improved somehow. And that might involve people, it might involve technology, right? But it's a process problem, okay? Now, for a lot of groups, coding is the second most common denial. And the first place to go to address that is to get a good claims scrubber, meaning software that helps you make your clean your claims out. They're called claims edits in some cases. So some systems have really great claim scrubbers and some don't. Okay. And so you have to work around that if you don't have one. Now, the root of any coding issue, of course, is the source of the coding. So if that's your providers, then they might benefit from some CDI education, or maybe even from having a certified coder code their notes for them. And then the AI tools for coding right now are getting very, very good. So if you are seeing a lot of coding denials, then it's absolutely worth exploring AI as a possible solution to address that. Okay. Pre-auth denials are now the third or the fourth most common denial, especially in your market. And so I would just say, guys, this is like a really aggravating game that payers play with us to deny claims. That's it. I don't believe any of the other stated reasons why pre-auths exist. But in order to win, we have to play this game, and we have to know how to do it well if we want to get paid. Okay, and that means we just have to get good at having a pre-auth and a good front end process to manage it. Okay, and you can see most of the other reasons right here, but let me give you a way to solve this problem forever, but it's probably not what you're expecting. Okay, the only long-term strategy for permanently eliminating denials is to prevent them from ever happening in the first place. Okay, and in order to do that, we have to get to the root cause and prevent it. And in order to do that, we need to implement a denial review process that is measuring the denials that we're getting and prioritizing them by impact and performance, or I should say importance, so that we're starting with the denials that are going to have the greatest positive impact on our financial performance. And unfortunately, that rarely happens in smaller organizations, because they're expecting the same person that is doing the appeals, that person is also the one that is going to provide the feedback. And you would think that would work, right? You would think it would work, but it's just too much work. 70% of all practices are understaffed in that one area. And because of that, what happens in real life is that the staff members who really fully intend to analyze root cause after they're finished working the denials, they never get to it because they're never able to get caught up with the denials. So what they end up is on this endless treadmill where they're never able to get to analyzing and preventing root cause. And so the only way to get off of this treadmill is to dedicate resources specifically for this purpose. That means that's that person's only job. They don't work denials. Their job is to prevent denials. And for a lot of organizations, that is really tough medicine because it's an additional expense. And for that reason, this resource almost never gets put in place. And so they end up on the treadmill forever. Okay, so I wanted you to have an example that you could take back to your practice and apply if you want. Okay, so here's an example. Over here on the left, you've got like this simplified depiction of what the rev cycle process looks like. And then when we get a denial, we're just going to break it down into one of three categories: coverage issues, coding issues, and everything else. Okay, and then our dedicated resource is going to review that for patterns, frequency, and impact. And then they're going to prioritize and suggest improvement initiatives that will eliminate the root cause, right? So now we've got a feedback loop. And that feedback loop repeated month after month after month will ultimately get your final denial rate down to less than 2%. So let me just give you a simple example so you can picture in your mind how this would work. So let's just say we're getting, incorrect patient information, or we're seeing issues with, adding, I don't know, units to J code, something like that. These are simple things that they don't affect base coding, and they can be handled with claims edits. So our resource would recommend adding some simple claims edits to our platform, and then that'll let us catch those before they're ever submitted. We'll provide the additional information, or maybe even additional education to a provider if that's needed, but that's going to catch them before the claim ever goes out, and so they don't ever get denied. And then we're on to the next issue we've identified, and we just keep on iterating month after month after month until we've addressed all the root causes. It is a systemic improvement process that will make sure that claims will go out cleanly the very first time. Okay. Now I know that's not a KPI, but I thought it was important to cover. All right. So our next KPI is our gross collection rate. And GCR is simply the percentage of your gross charge that you're actually collecting. Okay. And because this KPI is dependent on what you're deciding to charge as your gross charge, it's really highly variable across all practices. Okay. And for that reason, as a standalone metric, there's really no benchmark for this, right? You can't go into a party and say, hey, my gross collection rate is, 65% or something like that, because that's not a meaningful metric. What matters is what you're charging. And so all by itself, it really doesn't, it doesn't mean much. Like I usually see it around 30 to 65%, but I've seen as low as 25%. I've seen as high as in the 80s. And what it really tells me usually when I see this is about what percentage of Medicare your fee schedule is, right? So if I see something around 50%, then I know that you're charging 2 times Medicare, okay? In fact, a really high gross collection rate may mean that your fee schedule has not been updated in many years. And it's possible that you're actually charging less than the allowed amount for some of your contracts. And I just bumped into one of those last week, actually. So we probably don't want this number to be really high, okay? Gross collection rate, GCR, is really only valuable when it is trended. So that's what we're going to do. And if we see that it is trending downward, then that's an indicator that something's wrong with practice operations, and we need to go do a deeper dive on what's going on. But it is generally true that if everything else remains the same, that a downward trending GCR means lower cash flow and lower margins, okay? All right, so gross collections, super easy to calculate. It's just the total number of charges divided by total payments, okay? Naturally, the charges and payments need to come from the same period. And to get the real value of this KPI, like I said, we want to trend it month over month. And the chart that you see here on the right is actual data from a new client of mine in Arizona. And because we've trended it, we can tell without any difficulty at all that something is wrong with this clinic, right? We can, it's because it's trending downward, and we can tell that they're capable of collecting at least a 35% of their gross charge because they did it in January and February and March. But then something happened in April, and then it dropped down to 27%. It kind of hung there for a while until November, and then where it dropped down to 22%. That's when they called me, right? So unless something changes, like fee schedules, new payers, new providers, right? Something like that, when GCR is trended, it should be flat. It should be flat, or maybe even better, slightly increasing. But if we see that it's going down, that is a red flag that we need to go searching for what caused the drop. And the time we want to do that is the moment we see the drop. You don't want to do it in April. I mean, you don't want to do it in November here when you should have done it in April, right? Because that's a lot of wasted money, perhaps lost money, right? All right, so what kinds of things affect gross collection rates? Well, very high fee schedules just produce lower GCRs. That doesn't make it bad, but that is one of the main things. So if you change your fee schedule, it's going to affect it. Very low charge rates will also affect your gross collection rate, okay? And like I said before, if you haven't updated your fee schedule in several years, you might even be charging less than some of your contractual allowed amounts, which would be leaving money on the table. In addition to trending your GCR, you should also look at your GCR by payer. And that's a very easy way, even a very ordinary practice management system can do this trick. It's a very simple way to identify payer issues. And then undercoding will absolutely affect your GCR, as will underperforming insurance and patient collection processes. So inadequate insurance follow-up, denial management, big contributors to declining GCRs, as is ineffective front-end operational processes. So let me just check here to see if we've got a question. Nope. Okay, we're doing good. Next up, we've got revenue realization rate. And this is a metric that's new to some people, okay? And to be candid, I don't know why it's called a realization rate, because it's not really an indicator of how much revenue you realized. What it is a percentage of the charges that were either collected or written off, regardless of the reason. Okay, so I mean, even if those charges were not the bad debt, it is still included in the formula. And you're going to see in a minute why that's helpful here. But a lot of people confuse this number with the net collection rate, or NCR. And that's because there's a number of practice management systems that actually report this as NCR when it's not. Okay, and that can lead to a lot of confusion. But when we run it for 90 days in arrears, okay, then the benchmark for this KPI is 99 to 100%. And that's just another way of saying that after 90 days, we should have gotten to all the claims, payments, and adjustments, et cetera, one way or the other. And what this metric is good for is telling us whether or not we're able to keep up with all the work we have. Okay, that includes claims processing, payment posting, adjustments, and so forth. Is everything getting processed and completed? If we're not, then this number will be less than 99%. And just because of the nature of what we do, I see several hundred of these practice assessments every year, and I would say that this number is less than 90% in the majority of assessments that we do. And that is an indicator that most practices are actually running way too lean. They're having a hard time keeping up with all the workload. Okay, but if this number is low, then you're likely to have decreased cash flow and an overall net collection rate, which we're going to talk about here in just a second. Okay, so I'm going to actually skip this slide for sake of time to keep us on track here. But that brings us to a very important key point. This may be the most important key point, which is that each key KPI only tells part of the story. In order to see and understand the complete story, the KPIs have to be looked at together. If we only look at one or two KPIs, they can fool us into thinking that we're doing better than we really are. And in the case of the revenue realization rate, then what we also need to do is we need to look at our net collection rate, because the net collection rate will smoke out any other issues. And that brings us to our net collection rate. Okay. And I know I didn't show you how to calculate the revenue realization rate yet, because I'm gonna show you how to calculate both of these together at the same time. Okay. But your net collection rate is the percentage of the payments collected from the total amount that you're allowed to collect based on your contracts with payers. Okay, or said another way, what percentage of your collectible dollar did you actually collect? And this gets kind of confusing for non-healthcare professionals, right? Because other industries don't have the equivalent of the allowed amount that we have in healthcare. And so if this is new to you, the allowed amount is just the maximum amount that you're allowed to charge for a service, just for the privilege of seeing a given payer's enrollee or patient. So it's not the amount you get reimbursed, it's the maximum allowed amount you're allowed to charge, okay? And that means we have to write off any amount above the allowed amount as a contractual adjustment. Okay, and I'm going to show you how to calculate this in just a second. But the benchmark for NCR is between 95 and 96%, although it is absolutely possible to get it as high as 98%. So if you had a 96% net collection rate, that would just basically be saying that you're collecting 96% of every possible charge. Okay, does that make sense? Now, if you're not collecting at least 95% or better, then what that means is loss of revenue. You're losing money. It doesn't mean you're getting paid slowly. It means you're losing the money, because now we're measuring how much you actually are getting. Okay, it means decreased cash flow, but not because the payment's delayed like with other KPIs. It's because the money's lost and gone. Okay, a low NCR means lower margins, and that means that your administrative costs as a percentage of overall revenue is going to be higher. NCR also affects cash flow, and finally, NCR will affect your overall practice valuation in a big way. So here's how you calculate both KPIs. Okay, revenue realization rate is total payments plus total adjustments divided by total charges. And the net collection rate is total payments divided by charges minus contractual adjustments. Okay, so I got an example here to make it clear between the differences. Okay, I've got, in this example, we have total billed charges of 27 million. So total contractual adjustments are 15.5 million, and we have non-contractual adjustments of 950,000, right? And a total of 10 million.2, so 10.2 million in payments, okay? All right, so now let's do the math. So our revenue realization rate, if we take our payments of 10.2 million plus our contractual adjustments of 15.5 plus our non-contractual adjustments of 950, and we divide that by our 27 million in charges, we end up with a 98.7 revenue realization rate. Okay, seems pretty good, right? Okay, now let's calculate our net collection rate for that. So we take our charges of 27 million and we subtract our 15.5 million in contractual adjustments. Okay, and that gives us 11.5 million, by the way. And then we divide that number into our 10.2 million in payments, and that gets us an 88.69 net collection rate. Whoa, right? That 98.7 revenue realization rate looked pretty good a minute ago, didn't it? Till now. We're actually leaving at least 7% on the table now that we've seen the net collection number. And that's why you need to look at both of these together. These are the root causes of unhealthy revenue realization rate and net collection rate right here. And while there's some similarities in the list here, for example, high denial rates will affect both. They're different metrics. And so here's an easy way for you to remember and what they're good for. So in general, revenue realization rate is telling us about efficiency, right? And our ability to keep up with workload. So think about revenue realization rate as efficiency, while net collection rate is telling us more about effectiveness. How well are we able to collect every dollar or every penny that is due us? Okay, there's more to it than that, but basically that's a great way to think of these two KPIs. They complement each other very well, and they give us a good idea of where we need to go in our practice operations to try to make things better. Again, I'm going to teach a really cool skill here in just a minute, but what I want to do is I'm going to summarize this just a little bit, okay? All of these KPIs are interrelated. They're connected to each other. When one gets worse, the others will get worse. When one gets better, the others tend to get better too. And just as an example, you can see all the different things that a reduction in your denial rate will do. It'll improve a ton of different things. So they're all connected to each other. So don't over rely on a single KPI. And I wanted to give you a cheat sheet that you could use to identify which KPIs are best for which purpose in your practice. And so you can see that right here. You're going to get this deck after we're done. As well as a link to the recording of this video. So you'll be able to go through it any time, but this might be a page that's worth printing off and having next to your desk, okay? All right, so I promised to teach you a new skill. And so in the time that we've got left here, I'm gonna teach you something that you can use immediately after you're done with this session, okay? And what it's gonna do is it's gonna calculate for you how much actual revenue you might be able to achieve by doing a little bit better, okay? How much improvement is possible? And the answer to that question is unique for every practice. And some groups might be able to improve a little, but others might be able to improve a lot. And as it turns out, there's a way to calculate what that is using your practice's key performance indicators that you just learned, okay? In fact, we're only really going to use one KPI here, and that is the net collection rate. But it is one of the coolest shortcuts I've ever learned, and I learned this from Patty Peets, so I appropriately call it the Patty Peets method. And the key performance indicator, like I said, that we're going to use is your NCR, and your net collection rate is the percentage of reimbursement you actually got that you're allowed to collect based on your contract with payers, okay? So there is a repeat of what the formula is. And now the formula is easy, but there's still a little bit of nuance to getting it right. So I'm going to just cover these items real quick for you. I promise this is the hardest part. The real formula is really easy. The payments part of this formula includes all payments, okay? That should include patient payments. That's a collectible part of your charge, so you need to include it. Second, when you're subtracting adjustments, only use the contractual adjustments. Don't use all adjustments. Right? For example, don't use bad debt, right? Using all adjustments will skew your net collection rate upward and fool you into think you're doing better than you are. And in fact, that's literally the definition of revenue realization rate, which is not what we want for this. We want the net collection rate. Okay, next, when you run your report, you need to run it for 90 days in arrears. So there's been enough time for all the claim adjudication to have taken place from the payer. So if I'm going to run it for today, again, I would go back to March. as my latest date in the report, that would give it, 3 months would have been able to take place for my payers to have adjudicated claims. Okay, next, we're going to run a separate adjustment report for the same period. And that's going to allow you to much more easily determine which adjustments are contractual and which ones aren't. And then finally, just know that a significant number of credit balances will artificially skew your NCR upwards and make you fool you to think you're doing better than you are. So if there's just a few credit balances, don't worry about it. Just leave them in there. It's fine. But if you see a lot of credit balances in there, then you're going to need to back them out on the ones that you see in there. Okay. The rest of it is totally easy. And so these are the steps to calculate the actual dollar volume of improving your net collection rate using the Patty Pete's method. Okay. So you're going to calculate your net collection rate. That's the first thing you do. Second, you're going to use that same date or that same data to calculate your NCR and divide your total payments by your net collection rate. Okay. What that will do is that will give you what the value of 100% would be. Okay, as though you were collecting every dollar. Then the third step is you're going to take your new 100% NCR value and you're going to multiply that number by 95, 96, 97, 98, wherever you're at. If you're below 95, then just start with 95 and work higher. But if you're at 96, obviously you're just going to calculate for 97 and 98. That's going to give you the total value of the receivables at each rate. Then in step 4, you're just going to calculate the value of the difference for each rate. And to do that, you're just going to subtract the original total payments from your new higher NCR totals, and that calculates the value of improving your NCR. Now, that's a mouthful. Would you like to see an example? I'll bet you would love to see an example. Here you go. Okay, here's what it looks like. We run a report from June, and this is a real example, by the way, or I would have used round numbers. But we run a report from June of 2023 to May of 2024. Okay. And in that report, we see that we've got 19.2 in total charges. We see 6.6 in total payments, and we see about 10 million in contractual adjustments. That makes our net collection rate right here, okay, 71.76. And the value of our receivables at 100% is going to be 9.288. Okay, so there you go. Now all we got to do is take that number and multiply it by 95, 96, 97, 98. Okay. And to calculate what the payments would be at each of those net collections rates. Okay, and that's really the second column that you see right here in this little report. Okay, and then you're just going to subtract your original amount of payments. You can see these are all the same right here in this column. And then that gives us the value of the difference at each of the rates. Okay, and what you can see here is that in this example, which is a real example, that the monetized value of improving our net collection rate is somewhere between $2.1 and $2.4 million. That is basically a 30% improvement in revenue for just a few percentage points over this 71. So that's kind of surprising, isn't it? And the most important thing is that this revenue can be realized using the exact same services and volume that you're doing right now. You don't have to do any more. We just have to do a little bit better. Okay. And we don't have to add new services. We don't have to add new procedures. Okay. And so that's the moral of the story. The do better strategy can actually make a really big difference without having to increase volume. And so now you have the ability to go after this session is over and calculate your own upside. So give it a try. I think you'll be surprised. Give me 5 more minutes here, and then I'm going to give you some examples of how to do this. So with all that under your belt, the next thing you want to do is do a revenue cycle assessment. Okay, it's an in-depth look at the health of your whole practice, at least the rev cycle part of it. And it gives you insight that you can share, and we're going to use our standard KPIs. So we're going to benchmark ourselves against our peers. And so I don't have time to go through a full revenue cycle assessment with you, but I do want to give you a few ideas so that you can build your own. And so I'm going to just show you some real examples that we can go to school on here for a second. And then what I'd recommend is that you start with a comparison of your KPIs with the benchmarks that are put out by MGMA and other organizations. And that makes a really nice executive summary. And this is an example of one of those here, right? And this one includes 6 different KPIs on it. But if you want to get really ambitious, you could do as many as 25, but I would just say start small and then work your way up. Okay, in this example, you can see that both the net collection rate and the adjusted net collection rate are way below benchmark. Same thing with the ARE and the same thing with AR days and the denial rate, right? All of those are considerably lower than we would want in this little KPI executive summary. And then what I'd recommend is that you trend some of your transactional data. So what you're going to see here is two charts that illustrate a pattern I have seen many, many times in my career, where the charges and adjustments are trending upward. So we're working harder, but the payments are flat, okay? Or sometimes we even see them declining, okay? These trends help us identify potential risk areas with what's happening in the practice that would otherwise go unnoticed. That's why we trend it, okay? And then here's another example of transactional trending where the patient payments are trending downward right here, okay? But are, compared to our payer payments. And what we should see in all of these, by the way, is parallel lines, okay? But when we don't see parallel lines, then we know that something's up. And of course, in this example, what it means is there's something in our patient collection process that's getting worse and worse and worse over time, right? And it's something that we ought to take a look at. Okay, here's a couple more from the same account. So this is exactly the same account. And on the left, we see payer payments that are trending downwards. Right here, that's this dark blue line, okay, compared to our patient payments, which are trending upward. And then again, same data, just displayed differently here. We see payer charges are going up, and then we compare that to the payer payments, which are going down. So again, we're working harder and harder, we're getting paid less and less. Okay, and what this likely means is that this practice has a lot of problems with denials, and that's telling us to take a closer look at that. Okay, and we saw a chart that looked a little bit like this earlier. Okay, and so I'd recommend that you break out your aged balances by patient and then by payer. Okay, and this will help you identify whether your staff is able to keep up with workloads. This really should be at least 50% patient, but really better would be more like 66 or maybe even 75% patient balances once it gets out to 120. When you see really big numbers like this, it means that your staff's not able to keep up with all of the insurance feedback that's coming, either denials or requests for additional chart information. So I'd recommend that you look at your AR over 120 and then use this little formula that you can see down here in the bottom right here to calculate the amount of money that may be at risk because of your aging. I'll just leave that in the deck for you to try later as an extra credit project. And I recommend you do the same thing with your days in AR. And you can see this little formula right here will help you calculate what the risk is of having your AR days a little too high. Okay, and then I'd spend a little bit of time and I'd break your denials down into functional areas so that you can see and have valuable conversations about operational improvements, right? You can see, is it front, is it middle, is it back? Where in the clinic is the issue happening, right? And then this will help you get to the root cause of your denial so you can ultimately prevent them for good. And we didn't have time to cover this today, but if we see any issues with coding, I think it's helpful to do an E&M utilization and how you practice coding with each doctor. And in general, if you see some unusual, it pays to look at things closer. In this example, you can see that this group is undercoding their 214s and they're overcoding their 213s. Okay, and I can see Allison's giving me a little message here. Says we're almost out of time here. So let me just show this one, and I think we're done. So I like that little method that I just showed you, the Patty Pete's method. I use that at the very end, and I calculate what the financial improvement would be if we could get our net collection to a higher rate. So this one, the group went from 92 to 98. Here's what it would have been in terms of value to the practice. It's probably the most exciting and fun part of the assessment because the practice can realize they don't have to do any extra work to get that. We just have to do a little bit better job. So, all right, with that said, we can, Allison, I don't know if we're out of time. I'm happy to stay a little.
No, keep going.
We're good. What I was going to say is Patty wanted to do this with me and she wasn't able to. So what she said is she said, James, because we're partner members with SBCMS, if they would like us to do a rev cycle assessment form, we will do it for free. So if that sounds interesting to you, you can use this QR code that you see on the screen right here. We'll also send you the deck and we'd be happy to show you how to do one of these in real life, doing your own data. And then if you want to, you can, take the ball from there and run it on your own. But absolutely happy. We're happy to do it. We love analyzing data. And we do several hundred of them every year. So if you'd like to do one of those, we would be happy to do one. And Allison, I didn't see any in the chat in terms of questions, but if you've got any questions that you got that I didn't see, I'm happy to address any of those.
Well, oh my goodness gracious, James, that was amazing. That was so thorough and so instructive. And I think any practice would be so well served to at least consult with you on this, because it's just so valuable. And I see several of our attendees today I know who have active practices. So first, I would like to ask, would any of you on the line like to verbally ask a question? I mean, this is your chance here with our experts, with our expert, James.
Yeah, no shame.
Yeah, feel free to ask anything.
Also, if you want to do it more discreetly, you can always ask afterwards by sending an email, and we promise to answer if you don't want to air your question in front of the whole audience.
Yeah, if someone's a little more reluctant to do that publicly, we completely understand that too. Well, I will ask a really quick question, and believe me, I do not understand this billing management cycle the way our practice managers and you do. But I want to go back to something you said earlier about writing off a certain amount, and go ahead and be realistic about what you're not going to bring in. How much should someone look at writing off?
Well, the benchmark is about 5%, so 2 to 5%. But I would tell you that most groups are doing that worse than that. They keep in mind the people I work with are in trouble most of the time, right? So they're calling me. So when we will look at seeing how much they're writing off, but the real truth is many groups don't write off stuff when they should write it off. So they just leave it on the books for far too long. It's not
Right.
all it's doing is it's creating extra data for you to wade through as you do your normal work. And then it'll throw your providers off when you start showing them reports, because they'll think, oh, well, this AR is out there and I may get this AR someday. And if you're on an accrual accounting method, if you leave that data on your books, you leave those the AR on your books, then you're not getting the tax deduction you could be getting for it. So you should, if you're on cash accounting, then you can't do that trick. But if you're on accrual, you can write it off. And I did see just a real quick one here.
Oh,
It says,
good.
are the benchmarks to help practices figure out how they compare based on their practice size? So the answer is yes. So the most commonly accepted and used benchmarks are from Medical Group Managers Association, MGMA, out of Denver, Colorado. And they actually have those metrics by specialty. They also have them by region of the country, right? So let's just say, for example, that you're a cardiology group, in the LA County or whatever. Then they will have that data down to that level, so you can compare what the performance is in that market. They also have FTEs, or the staffing equivalents, and you can see how the best performing groups are staffed, and how the lower performing groups are. It'll show you in the 10, the median, the average, and the top performers, which are in the higher percentile. So I don't know if that helps, but what it kind of does is it lets you see that it's possible to maybe have your number be a little bit different than your number, and that maybe gives you hope that, oh wow, if we just did things maybe a different way around here, maybe we could collect a little bit more than we're getting right now. So good. All right, thank you. Yes, there is a lot of info there. So, and by the way, we have some of that. So Wahid, if you want, MGMA will charge you for that data, but if you want just a simple thing and you tell me your deets, you can reach out and we'll, I can grab a few metrics here and there and give them to you without any issue. So, yep, sounds
Nice
good.
of you, James. Thank you so much. That's really awesome. And thank you, Wahid. I'm glad I know Wahid is getting ready to take on some big projects right now. So that's great. I'm glad you guys can get connected there. Okay, would anyone else like to jump in?
I feel really bad. We're 5 minutes over time. So
Okay.
how about this? If you have a question and you maybe we didn't have time to cover it, just shoot us an email and I promise I'll take good care of you. So we'll get it answered. No question is out of bounds.
Well, you are absolutely amazing. You just reinforced for us how elated we are to be partnering with you. So thank you for the lovely presentation, just so thorough and so informative. And we will, to all of our attendees, as we mentioned, we will be sending out James's slide deck as well as a recording of this. And please take a picture of your QR code there. And we are super excited to continue to get you guys hooked up. If you want to talk more to James and the team, let us know. And James and Jeff and Kelly, thank you guys so much.
Thanks so much for having us, Allison. It was great to be here.
All right, we'll see you all soon. Thank you again very much. Great job.
Bye-bye.
Bye-bye.